mode.
Good afternoon, everyone. I, Sneha, on behalf of Wadhwani Foundation and National Entrepreneurship Network, would like to invite you all for the webinar and also introduce our expert, Mr. N. Shridhar. He is currently the Managing Director of Pegasus FinInvest Advisory Pvt, Limited, an asset management and advisory company located out of Mumbai. The firm specializes in M&A acquisitions, diversifications, rehabilitation, or restructuring of any enterprise. He is currently an advisor or board member for a couple of startup companies on business strategy and investment acquisitions, also mentors companies and facilitates their transition from small capital to mid-cap, large cap, takes companies public. So before we start the webinar, a few pointers for all. You will all be on mute. You can type in your question only in the panel provided. So now I invite Mr. Shridhar to take over.
Good afternoon to everyone participating in this webinar. I hope I am audible and my voice is carried through. Before we get on to this more important aspect of the funding and financing for startups, I'd like to take you through a brief overview in terms of the knowledge, idea, and what all comes together to form a startup idea. Before I take you through the funding options for startups, I'm spending some time on the concept of idea and knowledge as the key contributor for a startup, which then combines with other resources like labor, which I mean is management, along with capital, and evolves into an operating business venture. Like traditional economics talks about 3 M's of business. I'm sure all of you have gone through the economic textbooks, men, material, and money. I would slightly rephrase it to the current context and say it's motivation, money, and management. Management to include both men and women, unlike the old economists. We live in a dynamic environment, and knowledge is a key factor in a startup idea creation. Let's pause and take an example of a young high school couple. Odds are that they won't get married. Maybe the odds are 5%. If you have to bet whether they will get married or not, you will make money in the long run by betting they won't. However, if you have to bet on the single most likely person in the world for either of them to marry, their current partner is surely your best bet. So knowledge, it's true for knowledge too. Paradoxically, even if you safely predict that any given piece of knowledge will eventually be overturned or rendered obsolete, we can be almost sure that any given piece of knowledge is our current best bet. But that's what is on the table. Consider the following knowledge that was at one point of time considered to be true. The sun orbits the earth. DNA has 48 chromosomes. Cigarettes are not bad for you. Red wine is bad for you. These were all at some point considered to be true, but today overturned. Startup facts are just that, you see. What I intend to say is that these startup facts can lose their relevance because they're either proven untrue or more likely because they change over time. Some examples in technology, like price of data storage, the kind of price downgrade it has seen over last couple of 10 years. Number of people that own mobile devices, government regulations, specifically more in the Indian context. What was true maybe 5 years back is no more true today. So businesses which went with a regulatory arbitrage are now nowhere because regulations have changed. So all startup knowledge is susceptible to a half-life decay and is turning over at a rapid pace. So what is it then? If today's startup knowledge will be obsolete tomorrow, how should we react or how should we handle that? I think for a startup entrepreneur, these are some of the thoughts. There are sure many other takeaways too, that founders and entrepreneurs should realize that startup industry is immature and constantly changing. the knowledge tends to be more of a best practice than fact. Because today data exists in this environment which is chaotic, and then it can change, the variables change over time, and it's difficult to isolate those. Founders have to realize this and then live up to this axiom. The founder should never be afraid to challenge assumptions, because odds are the assumptions will turn out to be wrong. Perhaps even more interestingly, the second point is that good ideas for new startups may be found at the place where knowledge is overturned. Thus, to effectively, I was just going through the web and read about Peter Thiel's secrets at the Stanford lecture. Startup ideas may exist where you believe in a truth that most people do not. So take the example of data storage, which I mentioned earlier. Data storage became cheaper and security improved. So what did Box do? Box gambled that enterprise companies would keep their data in the cloud. It's a very dramatic change from what we used to think a years back. HelloSign bet that e-signatures could work today. So you see, entrepreneurs should anticipate these corners, what knowledge today will become obsolete tomorrow, and find their place accordingly. So that's something about knowledge and idea. And I'd mentioned labor here. Labor is more of management and execution and hard work that we need to put up in. And probably, a lot of people think that that you can own your own business with very little money and make a fortune. Probably that is not really very true, but it could be true in some of the service companies, which we recently saw during all this stuff that happened. And service companies could be, anything from auto detailing to being a freelance writer to being a property management consultant. But the key here is, the key to improve your chances for startup success is to be smart, be honest with yourself about your willingness to work hard, and research the business that you plan to do before you jump into the startup. So what is the key points? I mean, if I were to put them in a question answers for one's own self, I think we'll have to answer a few questions for yourself before you do the startup. Well, number one, do you believe that your business will succeed? Number two, are you prepared to do whatever is necessary to make your business a success? Number three, are you willing to work for little or no salary during the initial startup? Number four, do you know who your competition would be, or have you done some benchmarking? Number five, like Peter Drucker said, do you have a sales and marketing plan in place? If most probably all the answers are yes, then probably you're sort of ready to go ahead and plunge into the startup. But if they are not but yes, then probably go back to the drawing table and then take a very detailed look at what you want to do all over again. Then the next point is capital. The third corridor that I would think for a business enterprise is capital. I think we'll be talking in detail about this as we go through the slides on how to raise money for a startup. So as I said, most of the businesses are a combination of two or sometimes three of these top three things that I mentioned here: knowledge, labor, and capital. Sometimes knowledge and idea-driven business usually tend to be funded faster as they yield better. I would like to just take you through the background for the funding and financing now that we're talking about capital and raising money. It's always a struggle to finance your startup, and it can sometimes get a little bit confusing when you have so many options in front of you, or probably you don't have any options in front of you. Typically, people either fund their business with equity or debt, but then ideally one should look at all the options and look at what suits your needs before getting into the option of funding. The sources of funding startups. Now I'm going to give you a brief source which would which are the different sources of the startup. One is the self sources, second is the angel investors, third venture capital, venture debts. We'll come to it when we come to that slide. Then there are loans from NBFC and banks. Self sources. As an entrepreneur, you can probably opt with friends, family, and associates for funding due to your relationship rather than they really assessing your business venture. They often act as seed investment to get the business to a point where it will be able to obtain larger funding from an angel or a venture capital in times to come. Chit funds also run within friends. They still stand as a very accessible source for many entrepreneurs, but especially rural entrepreneurs. This culture is also slowly dying, considering the kind of subjectivity and frauds around this option. Let me now share with you some pros and cons on this sources of self-funding. Ideally, normally you work hard, and when you are salaried, you save some portion of salary to be used as your equity to start your startup. So obviously you are very confident of your venture and you bring in the money. But the pros of funding is usually obtained quickly when self-source funding is used. It potentially exists for mutual vested interest in the business because you and your family or your extended family come closer when you start funding each other's business. Investment terms are usually more flexible. But there are also cons to it because immense pressure to succeed can strain personal relationships. Friends and family have limited ability to understand, evaluate your business. To evaluate your business, and they will generally not evaluate a business but offer you advice which you may or may not take. They bring nothing more to the table as an investor other than capital, because essentially friends and family are more like they like to give the capital, but then they really don't make as an assessment of the business, so there is no great value add as you see. Angel investors are high net worth individuals who give the founder financing in exchange for an equity in the company. Investments range usually less than $1 million, or if you want to put it in Indian rupees, 5 crores. They often work in organized groups, while many invest on their own too. The advantages or the pros for angels generally is angels normally have experience in the industry and can offer helpful guidance and introductions in their network. They have a huge network, so probably if one angel is not able to fund you, he probably refers you to the other. The angels are also less rigid than venture capitalists, and thereby flexible business agreements are common. As Basil Peter says, angels often want to contribute more than money to an young company. Angels have the experience and inclination to be great mentors and valuable directors. There are certain disadvantages that are associated with the angels too. These investors really look at returns ranging from 25 to 30% in the long term, and it gets difficult to generate such returns. There is also only a certain quantum of money that they can bring onto the table. Also, there comes a time in the deal wherein the entrepreneur feels that he's a fixed income earner, despite all the hard effort and innovative ideas that he puts in on the table. Because sometimes the angel investor also gets, he involves himself too much with the venture. And you can also be forced to give up some degree of control over your company. Due to the high risk and the nature of angel investing, angels rarely make follow-on or repeat investments because your business might require more investment at some point in time, but the repeat investments do not come through from angels. There's also one point that I need to mention here. In the recent budget that our Honorable Finance Minister Chidambaram presented, there is some relief for all angel investors, or maybe an encouragement, because now angel investing will get taxed only at one point, which is at the hands of an angel investor, because the trust would be given a pass-through status. So I think this should encourage angel investing in a lot of startup companies going forward. Well, I know normally, typically, it's always important for the startups to put in a little bit of equity for the entrepreneur and then go to the angel for funding, because otherwise there is always this danger of angels taking over your business, and they run the business and then make you an employee over time, which ideally I think you should avoid. A venture capitalist Well, venture capital is a very good word, very glamorous word, at the same time also a dirty word on the street, because essentially venture capitalists come in at a time where the revenue flow is much more visible and you have reached a certain stage in your startup or maybe after startup. Still, the returns which they expect are always on the higher side vis-a-vis the risk undertaken when you compare them to the angel investors. Venture capitalists are investors who are willing to put large sums of money in exchange for equity and make their money on exit. Their exit could be either through an IPO, that is going through a public offering, or a third-party exchange or a third-party purchase. Venture capitalists are professional investors, and it's all about money as far as they are concerned. They normally look for investments that can provide them at least with 5 to 6x, 6 times return. So you better be prepared to go big. I mean, if you need that money and you're going to expand and build the business all out, so then you need the venture capital out there. The advantages of venture capital can access large sums of money and can invest large sums of money at once. And they also can provide expertise and assistance. Being a VC funded brings instant recognition and credibility to the enterprise. It also widens your investor base through networking and opens up doors to other investors in the investing community. Practically, the only option when you require large sums of money while building your business is the venture capital option. There are also disadvantages. As I said, they can only fund large sums, so only if you require money more than $1 million or more than a couple of $1 million that you go to a VC. Venture capitalists also take their pound of flesh in equity and control. They normally, typically a 2 to 8 million is for a 10 to 40% stake in the startup. That's how a venture capitalist views a startup business and where he wants to take his pound of flesh. Also, the time consumed to close the deal takes a long time in the venture capitalist case. It takes longer than 6 months. It covers, first they have to get interested, they do diligence, so that's all, it's a time issue. And you also need to have an exit strategy to cover up for your next round of investment. Because once the venture capital will stay on for say 5 years or 6 years or 3 to 5 years, and then you have to look for replacing him with some other private equity or a venture capital guy. So that's one of the other issues that you have. And venture capital also have sectoral preferences. So one has to keep in mind that too. Because there are consumer centric funds, there are technology centric funds, so they don't fund other ventures, so you have to have knowledge about it. The other form of funding is venture debt. It's actually an interesting idea, and it's more like how you want to structure it and what's the time of funding that you want. Generally, these are after the startup stage. What is venture debt? These are medium-term loans provided to companies backed by the venture capital funds. The USP here is that there may not be any collateral required. Funding can be in the range of 5 to 25 crores. That's $1 million to $5 million. Depending on the need and the stage of growth of the company. Funding is either done by a fund house having a lending arm, or by any other institution, or even by the same venture capital fund. Interest rates are fixed for the tenor of the loan and are similar to that of SME clients from banks and NBFCs. The advantages or the pros for this kind of a structured debt is venture debt is structured to specifically support seed and early stage startups. Hence, it understands the volatility of the business and provides flexibility to the entrepreneurs. It is a useful tool for the founder who wants to minimize equity dilution early on, because it can bridge the gap in funding requirement. For example, the private equity or the venture capital guy brings in X amount of money, and if you need a little bit of more money, but because of doing that you need to dilute yourself dramatically, it is better that you go and take a debt because it won't dilute your equity. These comes with the least amount of restrictions and can be utilized for any business initiative. For example, you can use it for working capital, you can use it for acquisition finance, you can tie it up for something else, you can use it for an operational expenses, anything for the business. Whereas typically funding from a bank, NBFC or institution comes with end-use restrictions. There are also certain disadvantages to this venture debt option. They normally come with a decent amount of equity kicker to compensate for the high risk they are taking. Typically, these guys come in and take a risk, right, because they don't ask for any collateral. But then to compensate them for the risk, they will have an equity kicker of 3% or 5%, which says that beyond a certain time frame where the business starts doing well, they will start getting a piece of equity to compensate them for the risk that they take. We'll go to the last option, which is also available. I mean, I put both of them together. It could be a bank or a non-banking financial service companies. I'll also explain the difference to you in between them. Banks are generally all those public sector and private sector banks governed by the Central Bank of India or Central Bank of the country in where they are. So they have a little bit more regulatory constraints while operating. Whereas non-banking financial service companies are so they also lend, but they are less regulated, so that is a little bit easier to get money out of them. That the difference ends. This is a standard option for entrepreneurs, but not for seed stage startups, because when you are at seed stage startups, you actually don't have any great history behind you for a bank to give you funding. One should look at bank funding only after the product has gone through seed or venture cycle and one wants to grow further. So banks and finance companies, non-banking financial service companies, fund up to 80 to 90% of the LTV. What I mean by LTV is loan to value, because loan to value the asset. If your asset is 100, they're happy to fund you right up to the 90% of the asset. But also that's depending on the credit history of the clients and also on the collaterals available. The collateral could be in the form of property, machinery, or marketable securities. Banks lend either long-term or short-term depending on the stage and need. They give importance to cash flows rather than primary and collateral security. For example, you have got SIDBI in India, which is Small Industrial Development Bank of India. You have got Credit Guarantee Fund Trust for micro and small enterprises. These actually are specifically set up to lend up to 1 crore to small enterprise, and that could be for working capital or capex without any collateral. There are advantages and disadvantages for this kind of funding too. The pros are and the advantages are like cheapest option, because normally bank funding should come anywhere between 14 to 18%, and they also depend on the interest cycle in the country. For example, currently you are got interest rates at peak, whereas you need money for growth. So there is this clamor for interest rate cuts. So obviously, I think you can talk about a range of 14 to 18% from funding from banks and this NBFCs, depending on what kind of security you have got to offer. And in order to boost the entrepreneurship and corporate growth, the economy needs to lower interest rates. I think in the times to come, in the next 1 year, I also expect yield curves to go down. So obviously, interest rates should soften, and we should be able to get credit from banks at a much lower rates. The cons are the collateral requirement or the security requirement that these banks and NBFCs normally require. They are very, very fussy and particular about the security that they need, and more so because these guys evaluate you from a financial perspective, and they really don't go deep down. So they are very risk averse and would like to sort of bind their lending through a collateral. And the banks are a place where they give you money when you convince them that you have enough. I mean, you say, I don't want money, then banks will come and give you money. But when you go to them and say, I need money, then they will take a lot of time to give you the money. Also, you know, they have these restrictions and conditions of you should have a 3-year track record, 3-year profitability and credit history, etc. So these are the certain disadvantages. But the biggest disadvantages for a startup entrepreneur from a bank funding is that there is a lot of end-use restrictions on the money that the bank gives you. For example, banks don't fund if you have to buy shares of some other company as a part of your startup. If you're acquiring some other small business to merge with your business, banks won't fund you. So there are a lot of end-use restrictions that banks have, but that can be sorted out if you can go to a NBFC. But NBFC, if they give you the money, then they have a lot of conditions on the collateral and stuff like that. So one has to evaluate this option depending on what kind of requirement one has. Now we have gone through all this 5 or 6 odd sources of funding for startups. Irrespective of which source an entrepreneur procures funds, the key aspect is he has to sell his business idea or proposal to the investor. Whether to an investor or to a lender, he has to sell his and make his idea compelling. Selling a business idea is more painstaking and time-consuming exercise than selling the product. So we shall now go ahead and talk about how to make a compelling business proposal for the investors or providers. Lot of good amount of time and lot of thought has to go in drafting the business proposal. So I would like to draw some key points while we work on how to do the business proposal. The debate continues on business idea first or then management. When I say management, is the key personnel who work with you in terms of the idea, etc. You see, in my experience, I have not seen so great business ideas funded for good management, but I am yet to see a funding deal which gets closed for a great business idea but for bad management. So essentially, while investors or lenders come and see, and even if you have a great idea, if they don't see you a great management with you, they normally would not like to fund you. Having said that, I would still say the key to a business is the idea and the product and the service that you're really giving, which has to be, you know, sustainable and scalable from a business perspective, whether it's on the demand side or on the supply side of the business. As I see, I mean, I can draw some parallels in terms of customer preference, pricing, etc. of the product, because all of this goes into a good proposal. You can't price a product which beyond a point which the market cannot absorb, or you can't supply a quantum of product in excess more than it can be consumed by a target customer. Let me give you an example. I mean, we used to be, when I was a director with Coca-Cola, this was some time back, and we had introduced a 200 ml bottle because fundamentally we figured out that a customer could not consume entire 300 ml beverage from a bottle, and always he left behind something, but he always felt that he was leaving money behind on the table because he leaves a little bit of product. So we said the actual serving size could be 200 ml for a guy going down on the road and wanting to have a soft beverage or a cold drink in a hot summer. So this 200 ml concept came from a sizing perspective, and that changed the entire dynamics because, you know, we increased volume even though we scaled the serving size, we increased new transactions, and the customer felt that he was realistically being priced for the quantum that he was, because he was not leaving anything behind. So these are all the kind of perspective innovations that you need to do, both from a perception and from the product perspective, so that you are able to price it appropriately to the customer. So all of this go into a compelling business proposal. Innovation. Most fund managers always harp that they require innovation. But from experience, we have seen they prefer innovation in an established markets only. I mean, they generally avoid or don't take a risk for against a completely new product market where waters are not tested. For example, venture capitals and private equity funds, they would like you to innovate, but they would say, given the market, given you continue to innovate in a tested market. But you know, ask them to take a risk with a completely new idea out of the box, they'll be hesitating to take the risk of fund you. This is an information for you, for example, but you know, you can turn the whole thought around its head, because look at Bajaj. They came up with their bikes with the DTSI technology, and you know, failure of this engine in the outside markets because the engine started overheating and it used to lose its power at higher speeds, and then so that resulted in lesser pickups in the sports bike. But then, you know, Bajaj used it for its own advantage because it used this single-handed USP to sell its bike, saying there is a better mileage if pickup is reduced. So if you remember, we used to buy Bajaj scooters and bikes saying that they used to give the maximum amount of mileage. But it was like their pickup was not that great given the technology that they were using. But they used the flip side to their advantage for some time to come till knowledge and facts change, which is what you can go back to my first slide where I talked about facts and knowledge change and become obsolete over time. So product innovation, once again, is one aspect, and creating a perception for product innovation is another aspect. So one needs to keep that in mind while defining a proposal. And also one needs to do a unbiased SWOT analysis, which essentially is strength, weakness, opportunities, threat, to increase the utility of the proposal. What more is required? I initially mentioned management. Management or execution capability, as I call it, is the key to a sustainable and a scalable business model. A renowned venture capitalist has mentioned that he produces so many high energy ideas without any mention of how they were going to be executed. So fundamentally what we are saying is one cannot feel the market dynamics and ruthlessness of the market till the time you go and spend a few bad days experiencing it. So summary, executable ideas only work into a sustainable business model. Then the guy has to also have some vision in terms of what it indicates, that the idea is thought through and it is scalable, sustainable. Further, there are few ventures where a group of entrepreneurs come with similar kind of profiles. For example, 3 or 4 people join and start a venture. All of them would be technology guys, or all of them could be engineers or photographers for that matter, but they do not have an idea of all the other critical business functions are going to be managed or executed. So that's where they need to bring in skill. Other point that one needs to keep is investors are very aware and want to know what are the ethics of the management, and while they don't discuss it too much, it's one of the key hygiene factor in closing the deal, because one has to keep evaluating the proposition. Apart from the above mentioned, we also require entrepreneur to be patient and understand that raising money from investors is difficult than selling to customers, essentially because they are fewer in number as compared to customers. Thus, if you walk to a bunch of them, 25% will show interest and 10% will go through the diligence process, and finally 1 or 2 will have serious interest to take it forward, but they too will try and drive a difficult bargain. So one needs to keep that in mind while they are doing the compelling business proposal to an investor, because these are all the key points that one keeps in mind. The other important aspect that I want to bring in is more in terms of the management of day-to-day, the nut and bolts, the key, which is also very important for the investor to look at. It is essentially the discipline which you follow, the day-to-day math, which is broken into different financial parameters for you to monitor and measure. As one said, you never measure anything, you never monitor if you don't measure. So you have to first measure, and so that you can monitor those indexes. Per day overheads, this is place where the entrepreneur has to assume the number of days the proposed entity is going to become operational or is to be operational. You have to compute the actual working days, remove the public holidays, give allowance for extra holidays, etc., and compute your requirements of your expenditure or overheads for those days. Then receivable cycle, I need not emphasize more on this, and especially if you're a startup, and collection is one of the most important aspects. Various factors like billing, you should bill on time. Entrepreneur has to keep his accountant motivated in small firms, because few line functions are not taken very seriously, and then you lose. If you don't bill on time, you will not even monitor your receivables. Proper follow-up on payments, receiving checks and immediately presenting them to the bank. Even here there is some time lag involved. So if you do this, automatically you reduce your cash cycle. Then big balances in both current account and term loan. For example, you have a current account at the bank, and you are collecting money, and there is a surplus cash, maybe few lakhs or few crores, but then you got a term loan account where your loan is outstanding and you're not paid the term loan installment or the interest on time. Whereas there is a loan on which you're paying interest, and on a current account you're sitting on surplus cash which is not earning you any interest. Always remember, every rupee counts and you do not own the bank. So, instead of having a current account, you then convert the term loan into a cash credit facility. So you are only charged to the extent of money that you use in a bank, rather than paying a fixed sum of interest on a fixed amount of term loan that you have taken. A cash credit is something which is in between a current account and a term loan and allows you to have a flexible usage of money. Then you should always not ignore plant maintenance or debottlenecking, because sometimes it's like an example. A truck, you own a truck business, that you sort of discredit or shout at the truck driver for overloading, but most of the entrepreneurs knowingly commit this mistake and reduce their plant life. These aspects are known to everyone, yet are actually applied and followed by very few. And these, if you add on the inventory cycle, the receivable cycles, the overhead cycle, you will see that there is X amount of cash that will come out of your own business, and that you don't need to go out and borrow. You can manage your working capital better. You can manage your cash cycle better. That is very important, as I would see, to manage discipline across. Obsolete stocks, money stuck in the stocks, utility of raw materials, finished goods, they tend to decrease over time. Rentals you pay for storing them, the inventory storage cost. I'll give you an example. I was involved in when I was running a retail business in Future Group. There is one, I think that's a case study also, the loot example. This is a combination of knowledge and inventory management, because fashions keep changing. So you buy stocks and keep it, but suddenly people don't like pants or jeans with big bottoms. They suddenly go for narrow ones. All the inventory of big bottoms across the different states in the country, they lie in inventory and they have to be written off. So an active inventory management system or a vendor managed inventory or just-in-time kind of thing really helps. So your eyes and ears and your thoughts should be glued on. Plus you should, and the knowledge factor which we discussed earlier also helps you to keep yourself in the trend, in sort of monitoring the trends and different facts that come in the environment. So this aspect, when well thought out, do help the business not only to get finance but also for swifter execution. And I once again emphasize that this is very critical. Whatever you do in a small scale or a large scale, your discipline in terms of managing your numbers, managing your financials is very important. That's what makes the difference between a good and a great. And investors definitely take a look at that. So now we come down to the value proposition part of it. Because finally when you put up a business proposal, then there is a value which is on plate for which the entrepreneur seeks a value. Then there is a value at risk for the entrepreneur because he has put his equity and he has also taken some loans by mortgaging and by giving guarantee backups. So what's the key to this? There should be a balance. Value at play should always be understood with an open mind, especially for the entrepreneurs. Normally entrepreneurs who are knowledge based, they tend to think that the idea is his and thus he will give the least to the investor. But in quite few cases, I have found that the proposed business does not appear to fall in knowledge related domain or service. It could be a product or service business which can be replicated. So obviously the entrepreneur has to temper his value expectations. Similarly, value at risk. Value at risk is the possibility of markets changing, assumptions not working out, the business falling apart. Then not only have you lost your equity, but also you have to pay up to your lenders. That's a double whammy. So essentially, entrepreneur has to understand this and temper his expectations and arrive at a value after balancing both risk and opportunities of his business model. I'll come to the last part and the most important part from an investor perspective, which is exit, which also needs to be built into your proposal to make it so that the investors can get a feel of it. Exit plan. Entrepreneur has to appreciate that an investor would like to exit at its own will. entrepreneur also need to give flexibility that in case investor decides not to exit, then he may have an option to do so. And an investor expects a risk-free return plus a risk premium. So that's how I said an angel investor looks at 30-35% return, because he clearly needs a 20% over the risk-free return of 10%. The other important aspect is that exit plan in bad scenarios also give an additional comfort to the investor on the business model, and also assures the investor on the willingness of the entrepreneur to pay back the money. Because if the market conditions are bad, or if the investor wants to exit, but then there are not great valuations, then there are various ways of, buyback options built into the contract, or that the entrepreneur agrees to buy back the equity at a percentage return, maybe 3 years down the line, something like that, or he tries to get some other investor at that point in time. So these kind of options make the investors feel more comfortable. While planning an exit plan, always remember, all will target a 20% or more to a risk-adjusted return. Thus, if a risk-free return in the current market is around 10%, then they would at least expect a 30% IRR from their investment, and an exit opportunity built into the proposal, at least in a 3 to 5 year time frame. So I think we have gone through how to build a proposal, right from how knowledge or idea can help it, how managements and capital form, and what are the different forms of capital. So conclusion is there is no secret to raising capital and or funding your startup. Thus, a compelling idea, knowledge-based product or service offering, coupled with an appropriate engagement of the management and the entrepreneur together, with the great executive ability, and what I mean is an ability to execute and sustain, will always have takers and investors. So write a compelling proposal and execute it, because investors as a breed are always sniffing for value accretive business proposals to invest in, and with a clear view to make 3 to 5 times of the money in a 3 to 5 years time frame. So there is no dearth of investor where you have got a good knowledge idea product or a service and you have written a very good business proposal. So wrapping up the whole thing, I'll quickly say that a business proposal needs to sustain on 4 pillars, which is idea, sustainability, scalable growth, and exit options. While the pillars are numbered, but irrespective of the number, all the pillars are a must-have for the proposal to sail through. Ignoring any of the pillars will have an impact on the investor mindset. So be careful while writing your business proposal. There is no difference between these 4 pillars. As we have taken an example where an entrepreneur offers a good exit option, in such a case, the business has to be scalable and the growth has to be profitable. Then subsequently an exit option comes, right? Then only you can have an exit option. And to be profitable in the long run, business idea has to be good. And for the business idea has to be good, the knowledge base has to be constantly updated with new facts in the market environment. Knowledge becomes obsolete over time, so keep updating. So constantly challenge even your most accepted hypothesis and create your armor of knowledge around your business to be able to sustain and drive. I have finished the hard aspects of capital management and the sources and funding options. Now I'm just talking about a little bit of soft skills that you need to have while you deal with your investors. Control your expectations, because this will help you to keep disappointment at bay. See, raising money is the second hardest part of a startup. The hardest part is making something people want or solving a problem. Most startups die because they probably don't have a great idea or a great product, but there are also many startups for whom major cause of death has been the difficulty of raising money. Reasons: brutality of the markets, randomness of the investors' behavior, which will affect you. So you have to take stock of these key behavioral stuff build it to yourself by dealing with your investors and raising your money. Lower your expectations because deals often fall through at the last moment. Keep working on your startup. Don't keep running after the investors and forget about your business, because startups need a lot of time and energy from your end. So if there are 2 to 3 founders, then allocate the responsibility. One will continue to manage the business, and otherwise it will suck all your energy. Fix meetings with investors in your spare time, and keep your business development efforts on and keep moving your company forward. Be conservative. When things go well, you can take risks. When things go bad, you want to play safe. I suggest approach fundraising as if it was always going to go bad, and approach it with a conservative basis. It's a very unstable nature of the system which makes me say this to you. Then you have to avoid, there are a few things that also I would like to add and then close this for Q&A. Avoid indecisive or first-time investors, because these investors are typically nervous. You know, if you go to a venture capitalist, he will ask you 2 questions. Whom are you talking to? How much are you going to raise? Do you have any fixed amount of funds? You know, you will try to act smart and try to manipulate the venture capitalist. Instead of that, be straight and simple and say, no, we are talking to a few people, we are trying to raise money, and we don't have any fixed quantum because we are trying to raise money as required by the business. Be independent. Different founders can manage with different quantum of monies, where you are just making enough to pay your living expenses till you become profitable. Investors like it when they can help startups, but they don't like startups which will die without their help. So if you go to an investor and say, oh, if you don't invest right now, I can't operate from tomorrow, they don't like such businesses. So be independent. So, you know, negotiation with investors and then succeeding and, you know, creating an impression on them is also very important. You know, that quality is very important. Like, for example, Sam Altman, who raised money, you know, you can parachute him into an island full of cannibals and come back after 5 years and he would be the king of that island of all the cannibals, because it's about the negotiating skills, and that's how we need to have with investors. Getting rejected by investors make you start doubting your own selves. Do not simply ignore rejections, but please understand first of all how common it is. A venture capital's rejection is very common. Typically a huge fund in the US with an office in India and advisory, each partner looks at around 80 to 100 deals in a year. He ends up probably doing 1 or 2 deals in a year. So what happens to the others that he has seen? He's obviously rejected. So what happens to those entrepreneurs? So if the entrepreneurs and they take this to their heart, then, you know, it doesn't work, because it's of no fault of theirs, because there is a limitation to how much of stuff that an entrepreneur or that an investor can look at. So I'm just giving this as information. Also avoid first-time or novice investors, because while they are very unthreatening and, you know, but they are very dangerous and nervous, you know. That's the problem. That's the danger about them. And if they are nervous, they will really keep going all around the place. So always remember, entrepreneurship is not for the weak-hearted. So you need the ability to be able to sustain through all of this, and then again sustain through all of this to raise capital and funding for yourself. Thank you, and then I will leave the floor open for questions.
Thank you, Shridhar. Now we'll start with the Q&A. Our first question is from Stavan, and he says, what are the interest rate in venture debt?
See, interest rates in venture debt, as I see them, today it depends on how the structure is, because venture debt comes in at anywhere between 14 to 18% again, depending on which institution or finance company is funding you, because venture debt is always given to a company which already has a venture capital investor in it. So there is this self-serving interest. So since it is given without any collateral and it's given without any end-use restrictions, it will come with a premium of 2 to 3% more than the bank debt.
Okay, our next question is from Tejasvi, And he says, are there
Yeah.
one or two must-haves without which an early stage entrepreneur shouldn't approach an investor?
Well, that's I think that's what we spent quite a bit of time. The the one or two must-haves is very clear. You have a clear idea or a with for or business or a product or a service based on which you have started your business. Ask 5 questions. Is the business idea going to work? I think I covered this in my first slide. That do you believe that your business will succeed? And more importantly, before you go to the investor, you have to write your compelling business proposition. I'm assuming that you've crossed your first 5 questions and you're ready to run your business. Then comes the raising of funds, before which you need to write can I write a very compelling business proposition for the investor? Number 2, can I convince the investor that it's a value proposition and there is a opportunity for him to exit after 3 to 5 years with a decent rate of return? So if these 2 questions you ask yourself and put that in the proposal, I think mostly the investors would look like this. Ideally, when I look at any investing propositions or co-investing or looking at for my clients or for businesses, you need to have sustainability, scalability, and an exit option for an investor to really get interested.
Thank you. Our next question is from Krish. He says, when you go and talk about your idea to different people, how do you protect it?
How do you protect it? Correct. That's a very important question, I think, because at the time of raising funds, you obviously go and meet many people, and as you raise funds, you have to share your business idea, your business propositions with them. I suggest that don't go and meet random investors. Meet investors and do formally execute a NDA, a non-disclosure agreement, each one of them. Not that these NDAs are are foolproof, but at the same time they sort of give you a little amount of comfort that he's not going to really go out and share this. So consult appropriate lawyer, build a very decent non-disclosure and the secrecy agreement, so that before you start discussing with the potential investor, he signs these things and then you start discussing the business proposition. But see, fundamentally, if you approach the right investor community, normally they follow these norms, but you have to also be a little bit careful, because if your product or service is it can be repeated or can be replicated, then there is this risk of always losing out. And then it's also about are you approaching a person who's well known in the industry and who will not resort to such things. These soft things also are very important, apart from being formally getting the guy to execute a non-disclosure agreement.
Thank you, Shridhar. Our next question is from Gaurav. He says, what is the industry practice in terms of percentage of stake one would part for the first round of funding?
What is the percent? See, that's a good question, because I gave a very broad and a general benchmark saying that typically people look at from 10% to 40% when they fund ventures between 1 million to whatever. It's a matter of how you evaluate the business proposition and what stage the business is. If the investor feels that he is getting in at a seed or early stage of the enterprise, I mean, you started the business, you've just been about to put it up, you're still in the process of raising your customer base and stuff like that, then the risks as perceived by the investor is much higher. So obviously he would like to get as maximum value as possible, essentially to cover himself from a risk and a return perspective going forward. So in such cases, I think typically an angel investor likes to take anything not less than 26%, because he feels that it could be anywhere between 26 to 50%, because he feels that he's taking a substantial amount of risk. He sometimes even equates himself to the entrepreneur by saying that I'm putting in capital. So that's about an angel investor at a seed stage. But if you believe that that your proposition is very value accretive and then it's going to create value maybe in the medium to long term, then my suggestion would be in the early stages you try to bring it, put your own equity or raise funds and from families and friends and relatives, or or maybe even angel investors, and get it to a stage before you really go out and raise large sums of money, because that would dilute your equity. So there is no fixed number in terms of how much percentage you normally use to part, but I would assume that if you're a startup and you got a knowledge-based business, an idea-based business, and it's not as if it's an exclusive one, then obviously you would like to the investor would like to at least to have a 26% equity stake.
Our next question is from Krish. He asks,
Okay.
are there any groups or forums that connect you to the right angel, basically someone who's interested in your line of business?
There are. I think you got this Bombay Angel Network, you got the Bangalore one, you got the National Angels Delhi, you also got VC forums. So there are communities, but still I would not say that it's a very organized concept at this point in time. You have to keep browsing through. You have to. There are also a lot of investors who do investing on an individualistic basis. I mean, they like to co-invest. But yes, there are forums. For example, you can register yourself with the angel forums in Bombay, Bangalore, etc. They are all available. Anyone can provide, or any of us can provide, or if they go out and search for these forums, they'll get it. But what happens in these forums is then you've got a formal process. You don't know who the investors are at that point in time, because investors keep looking at it and then they keep rejecting it, so you won't know. But at least that gives an opportunity for your business proposition to be showcased.
Question is from Nikesh. He asks, does investment by VC bring tax liability to startup for increase in value of equity?
Did investment from VC bring in a liability of tax on the entrepreneur?
Yes.
No. There is no increase in the liability of tax for the entrepreneur. A VC will invest through any of its fund or through any of its trust structure or any of its company structure or an offshore structure or an onshore structure. And they will be for example, as I mentioned, for the angel investors, VCs, it's an already established tax rule. The trust which invests gets taxed for the dividends and capital gains in their hands, and subsequently, if they are treated as a pass-through entity, then they are taxed in the hands of the investors. The entrepreneur doesn't have to pay any tax on the investments made by a venture capital or an angel investor. The entrepreneur has to pay tax on the business income that he generates out of the business.
Our next question is from Ankur. He asks, if you have been in business for 5 years already and the business is already generating profits, would you still be considered as a startup, and would an angel investor would be interested to invest in your business?
Well, if you already been in business for 5 years, you should have reached some stage or some phase of the organization in terms of whether it's stage 1, stage 2. Assuming the markets have been good and you have been running it successfully, obviously you have crossed the stage of a startup stage, and you are you are able to show revenues. Your revenues are visible. So then an angel investor may not be the right choice depending on what kind of quantum that you're looking at. So you would like to then go to a venture capital or a private equity fund and look for third-party investors, because this won't really get classified as a startup, because you would have a 5 years of operating history. But if your requirement is small and you're really not been able to scale up, and there has been because of new knowledge, new facts, or new changes in the environment, and you really now feel that you require one more dosage of investment, because it's as good as starting with some different set of assumptions, because the set of assumptions that you worked with didn't work out, then probably yes, you can still make an attempt and go back to an angel investor. But then you have to make a case for it.
This is from Krish. He says, when you go with an angel and say you invest 10 lakhs and he invests 90 lakhs, does equity need to be divided by investment, or it's an independent negotiation?
Can you come again, Sneha?
Okay, so he asks, when you go with an angel, say you invest 10 lakhs and the angel invests 90 lakhs, does equity need to be divided by investment, or it's
No,
an independent
no, it's not a
negotiation?
mathematical thing. It's not a math. If you're going to treat everyone, your value of share is rupee 1 per share, and everything is depending on the amount of capital to be put in. Yes, then you have to divide it by the number of shares. But that's not how it works. You may put in 10 lakhs, and you bring in the idea and knowledge to the table, and the product or the service to the table. So you may say, my 10 lakhs will give me 50% of equity. Your 90 lakhs may give you only 50% of equity. So then
Okay.
you issue shares at a premium to the investor.
Okay. Our next question is from Rajesh, and he says, can one look for funding for a prototype, for building a prototype?
Yeah, that is not an investment, but yes, you can actually look at what happens in this. Like in the US, they have got these search funds. Essentially, they fund you till you find a business, viable business proposition, and they give you some little small funding to help you to meet the expenses while you are searching for a nice business proposition, with a mandate that once you find a viable business proposition, then the right of first refusal lies with the investors who have funded you for this search. So similarly, building a prototype is like building some new product. So obviously you need to go and get a search fund to help you. And then if your prototype becomes successful, then the right of first refusal lies with the same bunch of investors who gave you the funding for the prototype. So you have to approach a specific group of people called the search funds. In India also, there might be certain institutions and certain funds which are affiliated to the campuses of IIT, etc., which can help you in this.
Our next question is from Raghu, and he says, should you plan for the future round of investments as a really early stage entrepreneur and in the first round of pitches?
Should you plan early for a early stage
Future,
of funding? You're saying
yeah,
for the.
yeah.
Now, what are the question?
He says, should you plan for the future round of investments as a really early stage entrepreneur and in the first round of pitches?
No. See, future round of funding is a requirement because essentially as a startup entrepreneur, you would go about getting your funding requirements for the next business plan period or a couple of years. And obviously you also take into stock the cash flows that your business generates. So fundamentally, one plans for the next 3 years or so, and then assumes that the business also generates adequate amount of cash flow, and then you start reviewing it again. But yes, you need to keep in view, depending on what is your business requirements or what is your requirements given your product or service and the business environment around you. And if you think that you require growth capital for the next 5 years to come because there is going to be rapid technological changes in the field that you are operating in, then obviously provide infusion of growth capital at different stages of the business stage, and provide for investors to come in and provide you the growth capital. So if you are in year one at startup stage and you have got a funding and you know that you require for some more expansion or technology renovation, etc., in the year 3, then you need to plan for your funding in year 3 too. And maybe if you are certain about it, then you can make those disclosures right away and build those into your plans. I have seen people, I've been evaluating a technology company, and then they know that they require an X amount of money for growth capital for the next few years. But they don't see funding requirements, so they are saying that they'll take one-time funding now and then try to manage it with internal accruals. And if necessary, they go for funding after 5 years for a growth phase.
Okay, our last 2 questions for the day.
You'll have to evaluate the business proposal. Yeah.
Okay. Our last 2 questions of the day. This question is from Vineet. He asks, is there any provision where founders take the money back, whatever they've invested in the company, once they get angel funding?
Well, the moment you tell any angel investor that you want to take your money back, the confidence is actually diminished. Fundamentally, founders, when they put their money back, there are 3-4 ways of returning capital. One is you take dividends if your company starts making good profits, or you do share buyback. So those are the kind of ways that you can do take your capital back, but you can't just exit that business. If you sell your equity to the angel investor, then you're exiting the business. Then you don't have any equity in the business. If the question is, can I keep my capital and continue to be the owner of the business? The answer is no. You need to have your capital in the business and continue to be owner. Yeah, you can decide the terms of equity capital between you and the angel investor right up front. You may say 100 rupees is required to run the business. I'll bring in only 10 rupees, but I'll still be a holder of 80% of the equity shares of the company. So be it, because probably your product or your service is great. So you really don't end up putting in much capital at all. And the angel investor puts in 80 rupees, but a 20% share, he's happy with it because he believes that he's going to get that kind of return. But you're going to say that, okay, after some time I'm also taking my 10 rupees away. How will you take it away? Either the company generates money and gives you dividend, or you buy back the capital, or the angel investor buys the capital out of you, then he becomes the owner. It's a structuring issue. I think what the question that he's wanting to ask is, the quantum of money that I have put in, I need to take it out. Yeah, you can take it out in different forms without diluting your equity. But then it depends on what stage of the company you are in, whether it's a growth stage or it's at a nascent stage. It's very difficult. No angel investor would like you to take your capital out.
Our last question for the day. It's by Chetan, is there any ideal proportion of different sources of funds? And for a startup, what should be considered as the best source of funding?
For a startup, right? See, the different sources of fund is either you bring in equity, which doesn't have an interest cost, but is considered to be more expensive than debt because of the return that you need to give equity holders. Then there is debt, where the cost is fixed because you are aware of what the cost is going to be year on year, and which is an interest cost. The debt is supposed to be beneficial because whatever debt you take in the company and pay an interest is tax deductible, and thereby you get a tax benefit on your P&L and balance sheet of the enterprise. So having an appropriate proportion of debt and equity really makes sense. But if you have 100% of equity, it will relieve you of the cash flow pressure in terms of repayment of debt and interest obligations, because you don't have to bother. But you please remember, 100% of equity means it's completely risk capital. It can be completely wiped out. And if you get more investors in, they expect you to give a much higher return than what you pay for debt. Equity investors look at 25 to 30% IRR, whereas if you take a loan, you only end up paying anywhere between 15 to 20% depending on what kind of loan it is. So the ideal mix could be, I would say, for a startup, because you are not really in a position till you generate cash flows to repay the debt, 60 to 70% of equity and 25 to 30% of debt to begin with. And as your revenue flows keep increasing, then the ideal situation could be 60-40.
Thank you, Shridhar. That was the last question of the day. So thank you so much for that interesting session. Thank you to all our attendees for participating in the webinar. We are glad that the questions kept coming in, but due to lack of time, we are unable to answer all. Please send in your feedback and suggestions to us at eclub@nenglobal.org. Also, if you found the session interesting, feel free to blog or post about it. The recorded version of the webinar will be available on our website eclub.nenonline.org by Friday. Also, NEN Entrepreneur Support and Training is conducting a workshop for entrepreneurs on protecting and managing intellectual property rights in your company at IIMT Gurgaon, New Delhi on March 16, that's next Saturday, from 10:30 a.m. to 4 p.m. We'll have 3 sessions. First, 1.5 hour on basics of IP by Mr. Ricky Chopra of Kocher and Company. Second, on legal aspects by Ms. Sunita K. Shridharan from SKS Law Associates. And the last session of the day will be by an entrepreneur, Mr. Dr. Atul Sardana, who will talk about his personal experience. Thank you once again and have a nice evening.
Thank you.